come and again into your learning morning and talk a little bit about LAS. But today I'm going to talk about my third hat, which is One Investment, which is an organization that was created through both LAS as well as a sister organization, the Municipal Finance Officers Association. And that organization, in conjunction with LAS, are the leads in terms of this program and the opportunities that it presents to you. So I wanted to talk to you a bit about this today. I've already kind of gone over, what LAS is. It's a group buying organization created by AMO, and as I mentioned, Municipal Finance Officers Association, which is an association that some of your municipal staff, such as treasurers, probably would be members of. But in terms of One Investment itself, it's been around since 1993. And it is an opportunity for basically group aggregation to achieve a lower cost in terms of investments. That's one principle of it. But the other principle of it is also to help you achieve some of your infrastructure goals, because a lot of the monies, obviously, that you're investing are long-term monies for infrastructure. So I wanted to talk to you a little bit about that today. And some of that investment is, obviously crucial to the work that you want to achieve in your communities. And being newly elected, for some of you, you may have some things that you wanted to achieve in this upcoming term of council. So hopefully this is of interest to you. So One Investment itself has about $3.2 billion under management right now, and that is in a broad range of investment funds. We have a high interest savings account, which a lot of municipalities use. We also have corporate bonds, government bonds, equity fund, and we also have some funds that are available for municipalities that choose to invest through the Prudent Investor Standard, and I will explain that in a minute. There are over 203 municipalities and boards invested with One. And in fact, it's a lot bigger than that, because we do have a number of municipally related organizations that actually use our high interest savings accounts. So it's pretty high in terms of penetration within the market and in the use, especially for the high interest savings account. So I wanted to talk a little bit about your role in terms of council. Council has a fiduciary responsibility for financial management, and you have to do this in an effective and efficient manner so that you can achieve whatever it is that you're looking to achieve within the municipality. And when I'm talking about financial management, I'm talking about approving policies, of which investment plans is one of those policies, and allocating financial resources, which is, what you normally do through your operating and capital budget discussions. But as I mentioned, it is actually the capital budgeting that is directly tied to long-term financial planning, and is something that we are actively working to increase the capacity and skills of municipalities on.
Hey, Judy.
Yeah.
Sorry to interrupt. Are you moving your slides right now? Because
I did, yes.
They're not moving on our end.
Okay.
Could you perhaps try starting your slideshow again?
Yep, let me stop sharing.
Sorry about that.
No, that's not your problem. Something's wrong on my end, obviously. Let's try again.
Okay.
Can you see my screen?
Almost there. I can see your screen.
Okay.
But it's and then yep, you'll start the slideshow.
Yeah, I just clicked on it. And now it doesn't want to move to slideshow. Of course not. Let me do this, folks. Hopefully that works okay for everyone and it's visible. And if I move slides, you can see them.
We're on the first slide.
Yeah.
Okay. Yeah, now we can see them. Perfect.
All right.
Okay, thank you.
No problem. Thank you for letting me know. So capital budgeting, as I mentioned, is tied into your long-term financial planning. The long-term financial plan is part of municipal asset management, and I'm not an expert on this, so I'm not going to delve much into it, but I can say that there is a regulation that requires you to have long-term financial plans. And you have to be able to know when you need to replace your assets. You need to know what cash flow you're going to need, all those kinds of things. Those things are important for asset management, but they're also really important for an investment strategy. So these are where, there's a dovetailing of your asset management plan, investing strategy as well. What investing allows municipalities to do is reduce the burden on municipal property taxes. That it's not going to eliminate it. It's not a panacea for that, but it does help to reduce a bit that burden. It also helps to ensure that your reserves are not eroded over time by inflation, which is really a critical piece, particularly in this current environment where inflation is accelerating quite quickly, although I'm hoping it has actually started to back off a bit. So you're probably thinking, yeah, but Judy, we don't really have monies to do kind of investing. And one investment, it was designed by municipalities for municipalities. And so we work with all kinds of municipalities in terms of the potential opportunity. And the minimum investment required is $5,000. You can go even lower for HISA, but for investing in terms of the bonds or equities, it's $5,000. But we also recognize that in terms of building infrastructure, there's lots of municipalities identified on this scatter graph that, if they raise their levy 1%, they're not going to get $20,000. So this is, a really important gap that needs to be addressed, and where we see an opportunity in terms of investing again to help offset the impact of municipal property taxes. Again, not the solution completely, but at least one other way, one other mechanism to deal with finding money for your capital needs. But we also know that municipalities are conservative investors. Now, this is before interest rates started to go up. Back in 2019 was the most recent financial information return data set we could obtain. So back in those days, the vast majority of municipalities were getting less than 1% return on their investments. So that tells me that most of their investments were probably in a savings account of some sort. There's very few that were getting more than 4%. And in order to get more than 4%, you probably would have been invested in a little bit of an equity strategy of some sort. So the message here, really more than anything else, is that we know municipalities are conservative in terms of investing, but we want to change that perspective a little bit as well to help develop those financial strategies. We also know you're savers. Lots of municipalities, save up for and then purchase whatever it is that they're looking to acquire. And this has been consistent throughout time, and I don't imagine it's changed since 2019. So, municipalities have saved up in about 65% of the case, dedicated revenue for whatever it is they're looking to invest in. The other 22% comes from from government transfer programs or grants. And then some, very few, about 14% take on debt. So this, again, is in keeping with the fact that municipalities are very conservative in terms of their financing strategies. This just breaks it out a little bit more in terms of your savings. A lot of that money is in reserves and reserve funds. But what I really want you to look at is at the very bottom, you'll see that 0.01% of the revenues municipalities have in their reserves is investment income. And that's something that we're trying to work to change because we see an opportunity there and a potential way of, again, mitigating property tax for capital infrastructure. So under the Municipal Act, and I'm not going to get into too much detail, but I do want to highlight there are two options for you to invest. You can go the route of what is known as the legal list, which is basically your municipal treasurer works with council to decide how you want to invest, what your level of risk is, and the treasurer executes it. Under the Prudent Investor Standard, the Municipal Act requires that the municipality join an investment board, or create an investment board, or join a joint investment board. I would suggest for most of Northwestern Ontario, you would not meet the criteria of $100 million to create your own investment board. So what One Investment has done is we worked with 6 municipalities to create a joint investment board, removing that barrier. So any municipality in Ontario that wishes to move to the Prudent Investor Standard can do so by joining that joint investment board. And what the Prudent Investor Standard is basically is anything that you and I as individuals can do based on our risk tolerance. And so this is just a picture of what exactly it looks like. So under the legal list, municipalities are restricted to Canadian bonds and equity funds. They cannot invest outside of Canada, which is a big risk. This doesn't actually go to scale because in reality, Canada has 2% of the securities available in the world. So it's very, very limited in terms of how many things that you can invest in. I think there's about 140 equity options on the TSX right now that are Canadian only. So it's a very, very small group that you're able to actually invest in. And then there's further restrictions specifically on the bond side of thing in terms of credit quality of some of the the corporations. So it becomes even smaller. Whereas the Prudent Investor Standard would allow you the whole world. You could invest based on your risk acceptance. You could invest in the whole world, which I think is a better way to manage risk. As you know, diversification is a good strategy as well as for managing risk. I'm not going to go into details on this. I will share the slide deck with Andrea afterwards because there is a video I wanted to share with everyone. But just basically summarizing what I've just said, that on the left-hand side is the legal list considerations, fundamentally being that, you know, municipal treasurers are responsible for executing whatever council decides is their investment policy. Whereas on the prudent investor side, what we do as an organization is we provide the resources and supports to the treasurer in executing a strategy. We have on staff a chief investment officer with Bay Street experience. We can give advice to the treasurer in terms of all of the developments required and things like that. So we're trying to extend the capacity basically of municipal treasurers who are very good at doing cash flow management and budgeting and all of that. But investment expertise is a whole different skill set that doesn't generally exist in municipal treasurers. And so we see this as an opportunity to help expand that capacity, as well as to increase that, 0.01% of interest revenue for capital infrastructure. So I just wanted to walk you through quickly a scenario, and this is a hypothetical one of, some years down the road, 10 years, let's say, you're looking to build a new recreation facility. And there's two options under consideration. Council could either annually decide to put away $500,000 and in 10 years look for the difference to finance this infrastructure project, or they have $6 million. They had some kind of windfall of some sort, and they've decided that they want to invest it for 10 years, and then they're going to build that facility in 10 years' time. So I asked our chief investment officer to do a bit of an analysis, and this is from the summer, so it is a little bit dated, but I can also say that, we have to do this based on past performance, so future is never guaranteed, but it gives you a sense of what it looks like. So these are a couple of different options. The far two right columns are you invested $6 million and basically forgot about it for 10 years. And these two columns right here are you invested $500,000 a year for 10 years. What this is basically telling you is that at the end of the time period, the 10-year time period, depending on your approach, either 100% in government bonds or all the way down to the prudent investor target date fund, you have different requirements in terms of how much money council would need to find to actually build that $10 million facility. But I think the most important thing in all of this is that you have actually earned interest that will offset the property taxes potentially. Same with investing and forgetting $6 million. Now, this red does not indicate that you need to find more money. This is actually $745,000 that would have stayed in the reserve for other projects as a result of investing 100% in the equity portfolio. We would never, ever recommend 100% in an equity portfolio. That is not diversified. It is very risky, but it was really just an illustration of the strategies that can be deployed in terms of trying to leverage what you have for those future date construction projects that you have. This is just another picture of it because I'm more of a visual person. So this is, you know, you've invested $500,000 every year for 10 years. The blue is your principal, so you're $500,000 each year. And the gold represents how much money you would need to find from other resources at the point where you're starting to do construction. This is a pictorial of what it looks like if you had invested $6 million and just forgotten about it. So again, you know, in the middle here is that fully equity position with 745,000 still staying in the reserve for other future capital projects. Again, risky strategy, but just to demonstrate that there is an opportunity, and a lot better opportunity than just leaving money in a high interest savings account. So you're probably all thinking, yeah, that's great, but risk is really high when you start to invest in equities. Risk is really high when you put it all in equities. There's a way to manage risk. But I think the other thing to remember too is that you need to match your time with when you need the money. You don't put money that you need in 2 years in an equity fund. You will definitely lose your shirt. Whereas if you put money into an equity fund for a 10-year project, the chances of losing money decrease over time. And that's exactly what this chart is trying to show you, is that in year 2 of an equity fund, your risk of losing money is very high. It could be as high as 30%. Whereas by year 10, your risk of losing gets closer to 0. And that's really where I want to leave you with, is that not only is equity definitely risky, but it can be managed risk. There's ways to manage this risk. The other thing is that we can help you do what they call in the investment industry a glide path. And this is just like when you're getting ready to retire. You know how you would change your mix closer to your retirement date than you would in your 30s. We would do the exact same thing for these kinds of funds so that you ensure that you have the money you need for whatever it is you're doing, 1, but also 2, so that you manage those risks appropriately. So I guess my message to you as elected officials is please don't be afraid of equities. We have a way to help you manage that risk, and we're more than happy to help you figure out how to do that to achieve what your community's goals are. So the last little thing I wanted to leave you with is, and I'm glad to see the new mayor of Nebing is online. Mark Tiver, welcome and congratulations. But also you guys are leaders in terms of investing. And we have a really great story of what Nebing has done in a very small community to take advantage of Prudent Investor and help them achieve their community goals in terms of their infrastructure needs. So I don't really need to go too much into detail. As I say, I'm going to share with Andrea this slide deck. Take a look at Laura Jones, who's the treasurer for Nebing. Take a look at her delegation to the Joint Investment Board, because Nebing is now a Prudent Investor municipality. She went into the meeting trying to explain who Nebing is and what they need and how this is going to help them. And she did a great job of explaining it, and a much better job than I could do at any time. So I highly recommend spending 10 minutes taking a look at that video, because I think it's a bigger testimonial from your colleagues than anything else in terms of what we can do to help you achieve your goals in terms of infrastructure projects. So with that, I am going to stop sharing, Andrea, and I'm more than happy to take questions if there are any.
All right, as I'm giving everyone a chance to think if they have any questions or not, I will send out, I did have a question come in about the presentations. We'll send out all the presentations once I receive them. So Judy, if you could send that right after our presentation. Yeah. And I'll send them out to everyone. And yeah, so there's another one. So we will be sending those out. And then a little bit later in the week, I won't get it all cropped out right away, but by Friday I should have all of the videos on YouTube. So if you wanted to reference back to something that was said, feel free to go that way. So now if anyone has any questions, they were mainly all about the presentations being available. Lots of good information coming through.
Well, I think what I would say, Andrea, is I recognize that counselors probably view their role as, you know, a little bit separate from administration. But more than happy to, you know, even if you just send our contact information along to your treasurer or your CAO, more than happy to have those conversations as well. Absolutely. And we will be at Roma, so stop by our booth if you're in Toronto for Roma at the end of January.
Yeah, I'll see